So in the last 24 hours, this is Thursday, Thursday evening after Dow closed on December 20th. So within the last 24 hours, we'll say uh, since the Fed announcement, since Jerome Powell came out, the chairman of the Fed came out and announced the 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 upward trajectory, if you will, of monetary policy, so far as the Fed funds rate was concerned. So in the last 24 hours, we'll say, the Fed, since the Fed took their action, and since they announced what their monetary policy is going to be, the the Dow dropped 1,000 points. Okay, so going roughly from 20 24,000, we'll say, down to 23,000. It's below 23, but at any rate, so it's about 1,000, dropped about 1,000 points, we'll say. And so, was this to be expected? I guess some people had this baked in, so on and so forth. But this really kind of begs some other questions, and those other questions meaning you have to ask the question why? Why did the Fed? Why have they adopted this policy, this monetary policy, wherein they're driving up the interest rates? The Fed funds rate was at between 2% and 2.25%. They drove it up from that to 2.25 to 2.5, and they're talking about at least another percent or so over the course of the next year and a half. So they're looking at driving this up to the 3% range, which is their quote unquote neutral range for the Fed. So at any rate, with that backdrop, so the reaction, of course, is why would the market drop by 1,000 points? Well, if you think about it, just in very simple terms, think about it this way: if the Fed, if interest rates go up, who's harmed by interest rates going up? It's pretty simple, very straightforward. The people that are affected, of course, are borrowers. Borrowers meaning it could be at the consumer level, of course, borrowing cars, borrowing, for mortgages, credit cards, so on and so forth. And there's a direct connection, of course, between when the Fed, goes about driving up interest rates, and we'll get into the structure behind that in a bit. But driving up interest rates, we'll say, and the reaction in the markets, at least in terms of the very short term, the near term, the negative impact, and it harms both the consumer and business, of course, because the cost of business goes up, according to along with the interest rates rising. Okay, so again, we're looking at the consumer and also businesses being harmed by higher interest rates. So who gains? Who gains from higher interest rates? You could argue that savers like higher interest rates, of course, but the point therein is that the problem with that, of course, is does not translate immediately. Just think about it in terms of like gasoline prices. So you hear that the price of oil is falling through the floor, which it is lately, and gasoline prices have certainly come down. But having said that, they tend to take their time. It tends to be a slower decline in prices, whereas if you hear that the price of oil went up by $10 a barrel, for example, you see immediate changes at the pump. In terms of gasoline prices, they go up immediately. So there's this lag, if you will, so far as interest rates, going up and translating into higher interest rates for savers, again, if you will. So at any rate, when we get into this, and this was the crux of this newsletter, we're talking about the Fed's actions, what the implications are, what the fallout is, and why it is that they're embarking upon these higher, trying to drive up interest rates. And what I mean by that, driving up interest rates, is that we're looking at the traditional way of how the Fed would operate. And so basically, the Fed as a body, the Fed meaning the Federal Reserve System, they have their monetary policy authority arm would be called the FOMC, or the Federal Open Market Committee. And the Federal Open Market Committee meets every 6 weeks, so they're always meeting, or on the verge of meeting. So it's every 6 weeks, a month and a half, if you will. And they meet, and the committee itself is comprised of the Board of Governors, which would include the chairperson, so there are about 7. And the numbers change. They rarely have all the folks that are invited, if you will, there every time. And you also have a situation where there might be someone that has resigned their position, and along those lines, at any rate. So the 7 governors, including the chair of the Fed, who is currently Jerome Powell, and they meet with the district bank presidents. So there are 12 district banks. So, for example, Detroit's district bank would be Chicago. So, and so we're going from Boston, if you will, as number 1, out through out to the West Coast, San Francisco being number 12. And so the district bank presidents are invited, of course, to this as well. So we've got 7 governors and 12 bank presidents, and all of their support crew. And so they meet. It's called the Federal Open Market Committee. They get together and they talk about the current situation. So bear in mind that when we talk about the Fed and we talk about the FOMC in particular, the focus, of course, is how the economy is performing. And what I mean by that, they're looking at macroeconomic indicators. And so specifically, we're saying in terms of macroeconomics, we're looking at economic growth, or we'll just say GDP, gross domestic product for short. There's a lot that goes into that, but a lot of other indicators that would go along that. But that's kind of the benchmark, if you will, the one that we would be focusing on, or the one that the Fed would be focusing on. So how the economy is performing. So that's economic growth. One of the other legs of the stool, the three legs of the stool, would be price level changes, or measuring inflation, deflation, and that would come in the form of from the Bureau of Labor Statistics. So the folks that do the measuring, again, back to the GDP, they'll be coming from the Bureau of Economic Analysis. The Bureau of Labor Statistics, they're responsible for looking at, again, the price level changes. And the price level changes, typically we think of it in terms of inflation. And that's because we typically have some degree of inflation. But then the fact of the matter is, over the course of the last several years, 10 years or so, we've had significant amount of deflation in that over that course of that time. So at any rate, again, the primary focus would be inflation, measuring inflation, concerns over inflation, if you will. And lastly would be the employment picture, or the labor markets, how the labor markets are performing. And this is, again, measured by the Bureau of Labor Statistics. And this is where we get our unemployment numbers, our monthly unemployment numbers. So the Fed is concerned about all these things, and they get together and they talk about these things. And the various district banks, provide data, coming from their areas. So again, it would be Boston, New York, Philadelphia, Richmond, Atlanta, Cleveland, Chicago, Kansas City, or St. Louis, Minneapolis. I know I'll miss one, one or two. Kansas City, Dallas, San Francisco. And again, I'm sure I missed one or two in there, but you get the idea. So they all get together and they talk about how things are going within their districts and how the overall economy is doing across the country. So the Fed gets together and they're going to determine what the monetary policy is concerned. So back to our newsletter here, what we're saying then is that to kind of walk through. This is to set the kind of table for this. So in order for monetary, when we talk about monetary policy, the way that the Fed goes about doing this is it's a process called secondary operations. And what we mean by that is that the Fed, rather than setting rates, this has traditionally been the case at any rate, and I'll clarify what I mean by that in a moment. But the idea again is that the Fed goes about this monetary policy by driving up interest rates by setting they set what's called the targeted Fed funds rate. And so stepping back again at this a bit, the Fed is the central bank of the U.S. So as a central bank, they wield a tremendous amount of power. They're kind of the keepers of the keys so far as like the amount of reserves in the system, meaning the amount of capital, if you will, the capital flows. In particular, we're looking at M1 money. M1 money, of course, meaning what we mean by that is currency and checkable deposits. The things that it causes. This is the lubrication, if you will, for the entire system to help the system move, rapidly, or to make the operation smooth, so far as the financial systems are concerned. At any rate, the Fed is at the center of this, and being at the center of this, what I mean is that they're the ones that are responsible for making the system work properly, the flow of credit in particular, and even more specifically, it's something that's called the federal funds market. The federal funds market has to do with the Federal Reserve, the Reserve Bank, the bank members, or the depositories that would be out there would include banks, savings and loans, savings banks, credit unions, commercial banks, and the like. And these are the markets that only these depositories operate in. So in particular, what I'm getting at is that this is where you're borrowing and lending reserves in order to create loans. And when you're creating loans, this is again creation of that credit, of that M1 money, of the checkable deposits. And without going into too much detail on that, this is by this market, this Fed funds market, the federal funds market, by making credit more available, this keeps interest rates down. Okay, so what I mean by that is that if there are adequate funds, simple supply and demand, if there are adequate federal funds, if there are adequate reserves in the system to create loans, then interest rates tend to stay low. So the way that what the Fed does then, in their monetary policy, in their monetary policy actions, if you will, when I was talking about buying and selling securities, think about it this way: the Fed, as an institution, the overall Federal Reserve. Now, if the Fed buys anything, the Fed can buy. If they could go out and buy anything. If they buy a $5 billion aircraft carrier, for example. Think about the transaction. So not that they would do that, but if they were to buy something, we'll just say Treasury securities, if they were to go out and purchase $5 billion worth of Treasury securities, they find a seller of those Treasury securities. This is in the secondary markets. They don't go directly to the Treasury to make their purchases. They have to buy them. And again, this is at arm's length type of relationship, separating even though the Fed is a fiscal agent of the Treasury, they operate at an arm's length, meaning that they don't directly purchase Treasury securities from the Treasury, if you will. They buy them in the secondary markets from, think about it in terms of Wall Street bond dealers, okay? Bond dealers meaning U.S. Treasury securities, bills, notes, and bonds, ranging roughly again from the 30, 60, 90 up to a year, and then on up to 5, 10, 20, and as long as the 30-year bond. At any rate, so this is the market that we're talking about. These are the markets that we're talking about, that we're referring to. So the Fed, if they want to buy, let's just say they want to buy $5 billion worth of Treasury securities from one of these dealers on Wall Street. And this is again why New York has a very important role to play in the FOMC. They have a permanent position, if you will, on the FOMC, but that's when we get into the voting rights in terms of the actual formal vote. All of them have a say. All the 7 governors and the 12 bank presidents have a say in what goes on in terms of the actual meeting itself. But when it comes to the formal vote, it's 7 governors and then 5 of the district bank presidents. So that means 5 of the 12, and more specifically 4 of the 11. The one New York has a permanent spot, if you will, on at the FOMC in terms of voting rights, the formal voting rights, and that has to do with them having an oversized role in the financial markets for one. And the timing, if you will, this goes back into the early part, 1914, we'll say, when the Federal Reserve Act was passed. So they had a major role involved with that, and they are also the ones that are responsible for making these bond sales, meaning selling and buying of these bonds. They're the ones that make this happen. So they're the ones that are given the marching orders by the open market to buy and sell these treasury bonds that we were referring to, or anything else. But we're sticking with the treasury bonds. This has been the traditional portfolio of the Fed, but things again have changed, since we've had some, going back to the financial crisis in '08. So at any rate, the Fed wants to drive up interest rates. So what they do, and this is a quick scenario, is that if they want to drive up interest rates, what they want to do is make credit less available. So how do they go about making credit less available? Do they buy bonds, or they buy U.S. Treasury securities, or do they sell them? So in this scenario, since we want to drive up the interest rates, we're going to direct, we being the FOMC, are going to direct the New York Fed to drive up the interest rates, a quarter point, meaning 25 basis points or 0.25%. So in order to do that, we determined that it would take $50 billion, we'll say. And so we want we at the New York Fed say, okay, we're going to be selling Treasury securities to the tune of $50 billion, 50 billion. So what that means, the actual transaction that occurs is you have $50 billion worth of Treasury securities in one hand, and you're selling them to a dealer on Wall Street. So the dealer on Wall Street, on the other hand, is going to be writing a check to you for $50 billion, we'll just say, you being the Fed. So the Fed takes possession of the $50 billion, from the check. It's taken out of the reserves. It's drained, if you will, from the reserves of the overall reserves from the Fed, and the bondholder receives the bond from the Fed, and they have that in their possession. Okay, so what happens in effect is that there are $50 billion is taken out of the system, because this is the only way that that the amount of the overall reserves can change. So when the Fed takes actions, okay. So just again, bear that in mind. So this is the normal standard routine. So if the Fed wanted to drive up interest rates, they would be selling Treasury securities that they have in their own portfolio, which was counted in the H41 it's their balance sheet, the Fed balance sheet, which used to be comprised pretty much of Treasury securities, but now it includes not just Treasury securities, but MBS, mortgage-backed securities, and their overall balance sheet is about $4 trillion. So all that aside, what we're saying is that those are huge numbers, of course, and there's a lot more that goes along with that. But the idea again is that if the Fed wants to drive up interest rates or to drive down interest rates, it would be buying and selling their they're called eligible, or they're called um, legal reserves. The legal reserves would be, again, these in particular, they are called, the legal reserves are referred to as the Treasury securities that the Fed has in its portfolio. At any rate, so if the Fed wanted to reduce the amount of the reserves that are in the system, overall reserves that are available in the system, they would sell Treasury securities. And if they wanted for example, if they wanted to have an accommodating approach rather than the restrictive approach that we just described, what they would do is they would buy Treasury securities. So they would buy Treasury securities, if you will, again, from those dealers that are out there in the secondary markets. And so people ask, well, what are these Treasury securities? What does all this mean? Think about it this way. The Treasury securities are debt. Debt, what I mean by that is that this is the overall debt that is sitting out there that's issued by the U.S. Treasury. Meaning, again, the debt that is out there currently is it's approaching $22 trillion, so $21.8 trillion. It's a huge number. And, you know, again, there's a lot that goes with it, but the Fed, the way that they function is buying and selling these Treasury securities in particular. So at any rate, what's happened is that in this latest round with the FOMC, the Federal Open Market Committee, what they did was that they determined that the Fed funds rate should be driven up. Okay, is going to go higher. So it's not going to. They're going to push it up from 2.25% up to 2.25 to 2.5, and then onward. And they're looking at over the course of the next year and a half, they're looking at probably another percent or so, maybe 1.5%. But again, they're looking for that 3% or more for their neutral target, as they refer to it. So the question, of course, you have to ask is that is this a wise move? Okay, and remember now, when the Fed, you know, according to its mandate, it's macro, looking at the macro, keeping it very simple in terms of inflation or price level changes, in terms of labor markets, in terms of the economic growth, the overall economic growth. So those three, there are three right there, right? Three legs of that stool that are out there. So if they're focusing on these things and they're saying they want the economy to stay on track, to remain stable, so on and so forth, you would expect them to be keeping these three aspects of the economy in mind when they're going about their monetary policy. Any monetary policy changes, they should have this at the forefront, right? So what's going on so far as the economy is concerned? Economic growth, one. We'll start with that. Economic growth. We're on track to be at 3% or more for this year. I'm guessing at the end of this year, we'll probably end up with 3.2%. I'm guessing, and you know, it could be a bit more. Hopefully, a bit more, but we'll say it's at 3.2%. The last time that our economy hit 3% was in 2005. So this is 13 years down the road. So, and bear in mind as well, when we're talking about 2009, 2008, 2009, we had negative years of growth in terms of the real economic GDP. The growth rate was negative. And so since that time, we've been kind of limping along, 1-2% growth rates. We probably averaged about 2% over the course of the last 15 years, we'll say, or I shouldn't say that, the last 13 years, we'll just say 2%. It's probably a bit lower, but we'll just say it's at 2%. Point being that in order for us to expand the economy, to grow the economy in the manner in which we really should, to get back to the previous trajectory, the pre-recession trajectory, if you will, would probably take us about 3 years of growing the economy at 5%. Now, that's when people hear 5%, they think that's that's a bridge too far. That's too much. That's too aggressive. But is it? I mean, I'll just say that we could talk through this. We can argue back and forth, and there are a lot of reasons why people would say that that's too fast of growth. Ultimately, what we're saying is that if we grow too fast, the concern, of course, is that we would encounter a lot of problems in terms of inflation. Okay, so which would diminish that growth and could drive us into recession. And of course, recession is always around the corner. So everyone is saying, "Oh, the recession is going to be within a year or so." This is kind of the, I don't know why, but it seems to be a bit of the consensus, and that concerns me because I don't see it. But that's for another discussion. So again, the point is that the Fed is looking at this and they're saying economic growth. So economic growth is going to be about maybe a bit over 3% for the year. So this is a good sign. This is the sign the economy is coming back, and again, there's a lot of room for growth within that economic growth as well. Okay, so that's one aspect, or one of the pillars, if you will. The second pillar, we'll just say, is inflation or price level changes. So our price level changes have been our inflation's been about 2%, 2.2%, I believe it was, over the course of the last 12 months. And this rolling average kind of going forward. It's not to say that there's no inflation, but inflation's fairly tame. And on top of that, a lot of the inflation that we've experienced in recent history, we'll say, has come in the form of energy prices. And now, when we think about energy prices, of course, we have to think about the cost of importing, natural gas too, but more so when we talk about crude oil. So crude oil, we consume about 18 million barrels, or how do I want to say this? We consume, meaning we process about 18 million barrels of oil per day into finished product. Some of that finished product we export to Mexico, Canada, in the form of like kerosene and other finished goods, gasoline and diesel fuel. Just for ease of transportation, meaning it's relatively close, so there would be back and forth across the border that way. And so we've imported well over half in the past, and now we're so far as the crude oil is concerned, we're importing far less because of fracking and natural gas. We're net exporter for sure in terms of natural gas. So what I'm getting at with this is that because we've increased our ability to produce energy, that's had a positive impact on us in terms of price level changes, of tamping down inflation. Because every time you see OPEC stepping in and trying to drive prices up because they want higher prices, they want more revenue, they want to exercise their market power and to get prices back up to the $100 level if they could. Every time that happens, you have fracking operations where it costs $70 per, our break even, we'll say, is running a well in North Dakota, and my break even is $65 a barrel, and price goes over $65 a barrel, I turn on the spigot, if you will. So this has had this domestic production, if you will, has had a positive effect in terms of keeping inflation down. Wages have been fairly stagnant, but they are on the rise, and there's no doubt about that. There are, specific areas, but in overall, there's been wages have been fairly stable. We'll leave that be. Point being, again, is that overall we're saying that inflation, and on the CPI level, the Consumer Price Index level, has stayed about 2.2%. The Producer Price Index has that's also been relatively stable, and frankly, the producers oftentimes have a very difficult time in passing those costs along to their consumers. But that's again for another conversation. Point being that inflation has been held at bay somewhat. So economic growth, where we've got room for more economic growth, uh, uh, and two, where the other part, the leg two of the stool, our price levels have been, fairly moderate. So our inflation has been fairly calm, and with no, every time that you see increases in the price of oil, uh, they they fall back. They do fall back down, and they have fallen back down because of the. It just all it does is that it just encourages more supply. Okay, so the last part of this is when we talk about this is always the tough one because number three is that what we're looking at is on the employment side, the labor markets. So labor markets, we have a U3 unemployment rate of 3.7%, lowest in many, 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 many years, and you drill down in it further, you hear things that, it's the lowest unemployment rate ever for minorities, and you can go through the whole laundry list. And so this is not bad news. This is good news, right? At the same time, the Fed is concerned about this because what happens is that um, you have tight labor markets. What does that do? So you're increasing your the supply of labor being diminished is going to cause prices to go up for labor. Labor constitutes, so far as income is concerned, labor constitutes, wages paid to labor constitute about 62%, or I shouldn't be so precise. We'll just say 60% of overall income flowing back to the household from the firm and the various aspects, but again, income flowing back to the firm, to the household rather, in the form of wages. So it constitutes about 60%. So of course there would be a concern if you have unemployment going down so low. And when we say there's a term called full employment, and that is basically triggered by uh, there's always going to be some level of unemployment. There's going to be seasonal unemployment. There's going to be frictional unemployment, structural unemployment. But when we say that there's no cyclical unemployment, we call that full employment, meaning that the economy is banging away, and all of the unemployment associated with a business cycle, again, if you will, would be would that's what the term cyclical unemployment is. And if we're at 3.7% by traditional measures, that would constitute us being at fully employed. And meaning again that the Fed would be very concerned about doing what? About reducing, the unemployment level coming down any further because it would just translate into higher wages, and so that would cause inflation, wage inflation, cost push inflation, if you will. So the Fed is very concerned about this. So how do they address that? Drive up interest rates. Okay, the Fed has how do I want to say it? When Fed drives up interest rates, it impacts both sides. I mentioned this already before, but it has a negative effect on consumers. So first off, the consumers, on you and me, you and I, we don't like higher interest rates because then it becomes more expensive for us to buy homes, to buy cars, to pay for cars on credit, to use our credit cards, etc. It becomes a more expensive proposition. We don't like that. Similarly, businesses are what are called deficit budget units. And think about it this way: if you had your choice, if you were a business, would you like to use your own capital, your own money, or would you like to borrow it? Ideally, it's not to say that that's the only way, but it's usually a little less. It's less expensive, and it's certainly less of a risk, if you will, borrowing other people's money. And I'm simplifying it and probably going too far with this, but the point again is that lower interest rates, entrepreneurs or businesses, managers at firms, for example, would be more likely to borrow more. It would be more likely um, to borrow more in order to to meet increasing perhaps demands. You have to have that economic growth, which we have. So this is kind of the natural thing. You would like to expand your business. You'd like to grow your business. So at any rate, uh, these interest rates are harmful for both the consumer and also for business. So it's it's a very, very straightforward. So the takeaway from this again is that um, the Fed has a tremendous amount of power in terms of putting the brakes on the economy. Driving up interest rates is going to cause people to pull back on the reins, if you will, right? Because both the consumer and also on the entrepreneur side, on the business side, you would be pulling back. You would be less likely to go out and borrow to incur more debt if your cost of borrowing goes up. So this is very straightforward. So the Fed this is what the Fed is doing. And again, the way that they're doing this is by driving up interest rate. In order to drive up interest rates, is that they are out there. This was that process where they're selling securities, so they're reducing the amount of reserves that are out there that are available for banks to borrow and lend between each other and to make loans for consumers and for also obviously for business as well. So the takeaway from this again is that the Fed is embarking upon this because they're saying that the economy is doing too well. Okay, so we'll just say take that at face value. Say okay, with the economy is growing too fast. What about inflation? Inflation's not really it's not really a problem. Oh, but wait a minute. What about labor markets now? Well, back to the economic growth. We could definitely do it with more economic growth. But back to again to the labor markets now. Labor markets 3.7% unemployment rate. The U3 unemployment rate. Is that a marker out there that should be paid attention to? Does that really constitute, is that justification for the Fed to drive up interest rates? Because that's really what we're talking about. We're not saying, if you think about it pragmatically, it's not a matter of where it should be at, where the rates should be, where they shouldn't be. It's where they are currently and what constitutes what would prompt the Fed to drive, or what should prompt the Fed to drive up interest rates? So in terms of labor markets, we're saying yes, we're concerned about labor markets being overheated and causing wage inflation. So let's look at this 3.7% unemployment rate. The reality is that the U3 unemployment rate is, just to put it into perspective, it's basically, we're looking at it's called the labor force. Labor force consists of the employed plus the unemployed. So you add the two of these together to come up with the labor force. Those people that are employed and those people that are unemployed. Unemployed, the U3 unemployed is made up of the folks that are not employed, but are actively, and this is a key point, actively seeking employment. So if you're actively seeking employment, that's the unemployed part. And if you look at the overall population, the civilian non-student, the numerator, if you will, is the labor force, the employed plus those unemployed that we just described. And that's over the civilian non-institutional population. Civilian non-institutional population is simply those folks that are 16 years of age and older. So it takes out the children, adolescents up to age 16. And it also takes out folks that are in the military, incarcerated, or otherwise counted in other institutions, okay? So it kind of pulls some people out. So that's the civilian non-institutional population. So going back through pre-recession, so pre-2008-ish, we'll say, we were looking at about a 66% labor force participation rate. Since that time, our labor force participation rate's come down quite a bit, and we're currently, I believe we're at 62.9%, our current labor force participation rate. At any rate, it's down significantly, and so what that equates to, what I'm driving at is that Why is it down so low? It's because we have a lot of people that are out of the labor force, that are not employed, and they're not part of that unemployed. The unemployed, of course, being those folks that are not employed but are actively seeking employment. So there are a lot of people that are outside of that. They're discouraged workers. They would be counted under like the U6 more so. There are different ways of measuring employment or underemployment by the BLS, the Bureau of Labor Statistics. And there are a lot of folks that are, we'll just say under a broad term, discouraged workers, people that are on the sidelines, that are not in the labor force. And we all know people that are in this boat. So the way that somehow, the conventional wisdom, the way it's explained away is that, of course, the reason that the labor force participation rate is so low or has dropped so much is due to the baby boomers. So baby boomers are people born from 1946 to 1964, and they're the ones that are moving into their retirement years. Okay, so the point again is that we're pointing a lot to retirees and are causing that number to come down, people leaving the labor force. But the reality is, and if you break this down, you go back, we've done this before on our newsletter, and we've looked at the different age groups, the different age cohorts that are out there, so to speak, uh, that are broken up 16 to 24, 25 to 34, 35 to 44, 45 to 54, ages 55 to 64, and 65 and older. And there are other ways of cutting this up, slicing and dicing up these cohorts, these age cohorts, if you will. But that's kind of the way we've been looking at it. And what we've basically found is that the 16 to 24 dropped significantly. And all the way basically up through the age 54, has fallen off significantly, and as much as high as is up to age 54. And whereas the folks 55 to 64 have gone up a little bit in 2017, for example, and the age 65 and older, these people are staying in the labor force much longer. And that's not to say that they're not retiring, because it's a huge number. Remember, 10,000 per day are hitting that 65 age, um, moving into those retirement years. But they're staying in the labor force at a much, much higher rate. So there's a problem that comes up, and the problem is this. Yes, people are retiring. People are moving off into their retirement years in terms of the baby boom. Many are staying. Okay, uh, but the real troubling part is that the younger age cohorts, the 16 to 24-year-olds, et cetera, going on from there, those folks are not participating to the level that they were prior to. So that's explained away how. It's really not. It's just kind of people say, well, uh, you know, those younger age groups they don't have the skills, and frankly, 16 to 24, these are jobs that are minimum wage jobs, for example, not necessarily just minimum wage jobs, but I think you're following where I'm going with this, and that is that these are jobs that are important. These are formative jobs. These are jobs where you learn how to work out there going forward in your career. And so uh, these people are not working. These 16 to 24-year-olds are not participating to the level that they ought to be, that they were pre-recession level. So I'm saying that their participation rate, because if the economy is doing so wonderfully, then their participation rate should be significantly higher than it was prior to the recession. But that's again for another topic. So another discussion. So what this boils down to then is that there is slack in the labor market. I don't think you can argue that there isn't. There is a significant amount of slack in the labor markets, and I'm saying that number is north of 3 million. We'll say is probably as high as 5 million people that are sitting on the sidelines that could be pulled and should be pulled back into the labor force. Bearing in mind that there's also on a monthly basis there are 200,000 more that would be added in. So we'll just say it's a wash, if you will, between those that are going out and those that are coming in, in terms of if that's the case, we're still looking at this additional 3 to 5 million over the course of 3, 4, or 5 years. So we're looking at we're we're probably looking at we could have increased employment, to the tune of 100,000 or 200,000 per month, at least for the next 2 or 3 years. So this is again against the whole backdrop of the Fed doing what? Driving up interest rates because they're concerned about labor markets heating up too much. To me, that makes very little sense. So, these may seem rather fine points, and the Fed is going to do what it's done, and I understand their rationale for doing this. They want to straighten out their balance sheet. They want to reduce the size of this ginormous balance sheet that they have with $4+ trillion, and to get it back under the $1 trillion, in that $1 trillion range. It's going to take several years to do that. But at the same time, when we're talking about driving up these interest rates, we're in extraordinary times in the way that they're going about doing this, because traditionally in the past, as I was saying, you're selling and buying treasury securities. So if you want to drive interest rates up, you would sell treasury securities. So rather than do that in the traditional manner, the Fed instead is they're taking a different route, and that different route that they're taking, if you will, is that they're raising the FOMC is getting the marching orders. They raise the targeted Fed funds rates from 2.25% up to 2.25 to 2.50%. So they changed the targeted Fed funds rate, but they're also paying for those reserves that are out there to the member institutions. They're paying that interest on those reserves, whereas that was not the case in the past. It's just and you could argue whether or not that's it should be the case, but this is a departure from the way it had been. In effect, what that does is that the Fed, you could argue that they're picking winners and losers, meaning they're picking winners in terms of the folks that are getting, collecting this additional interest that they wouldn't have collected before. And, again, you could say they should have had it in the first place. And I'm not getting into that argument. I understand, the other side of this as well. Makes some sense. You could make that argument. But I'm saying that this is a departure. So the takeaway from all this is, again, is it advisable for the Fed to drive up the Fed funds rate, to drive up these interest rates? We don't have to go back very far. We can go back to probably 2006, 2007 with Alan Greenspan's conundrum when he was at the summer meeting in Wyoming at Jackson Hole, where they get together and they chat about these things, and he's talking about his conundrum about trying to deal with the wealth effect at the time, meaning did not like the idea that people were cashing in on their home equity. They were taking out home equity loans. They were selling off their stocks and cashing in on different things, and there was a concern that this wealth effect would kick in, where people were buying things that it wasn't based on income, it was based on the wealth that they had, and using their homes as piggy banks, etc. And so this is the kind of the trajectory that we're on once again, with the Fed saying, well, the economy is improving, the economy is growing fast, and saying that, well, the labor markets are looking extremely strong. Too strong, which prompts our actions. And I'm saying that's just simply not the case as far as labor markets are concerned. If you want to argue that the economy is growing too fast, you could make that argument. I think it should grow and can grow significantly more and should grow significantly more to get us back up to that the pre-recession trajectory. And that's very important to do that, because that's where, when you have economic growth, this is where you end up getting more in terms of payroll taxes. Bluntly, this is this is what's going to help ensure a more solvent Social Security trust fund going forward. And that's another discussion. But again, very long talk. But the point here again is that I don't see the Fed posture right now being entirely justified. I understand why they're doing it. I understand the rationale for it. But again, I have trouble with it, and we'll see what happens going forward.